Woo! Things are getting exciting, guys. Man, I am super pumped for this video. So bear with me, we got a lot to go through. But before I get into anything, hey, I just want to remind everyone this video is not financial advice. I'm your financial advisor, but the way that I give you advice is one-on-one to you, and it's the way that I manage your portfolios. But hopefully you find this video encouraging, educational, informational, and it gives you some context as to how I'm seeing things in the market. So I just got to say, I am actually way too excited right now. So I apologize if that comes across as in any way being out of touch. I'll do my best to tone it down, but I do want to just make it super clear that right now, in my opinion, this is an incredible opportunity to be invested with BR Legacy specifically, and even to be adding more funds into firm management. That's no pressure, of course. If you don't have extra funds, then don't, stretch yourself. But if you happen to have a chunk of change that is on the sidelines right now, I would consider transferring it in if I were you, because I find it highly unlikely that we will find an entry point this attractive for quite a while. And I find it highly likely that your accounts will appreciate significantly over the coming months and years. So I will leave that there. Some of you know, about a year ago, I offered a similar plea last April, and I wasn't wrong then. Okay, so just think about it. Again, it doesn't really matter to me personally if you do or don't, but as far as my conscience is concerned, I feel an obligation to communicate if I ever feel there is a particular attractive window or a particular exciting opportunity. I want to make sure you hear that from me so that, 6 months from now or a year from now, you're not thinking, man, I wish Jeremy would have told me, So that's that. So in my video last quarter, I spoke to my expectations for 2025 in probably about the last 10 minutes or so of that video. And in short, what I shared is, hey, I think we probably have some moments of violent volatility still ahead for us. And I think we are at a very real risk of a recession. Now, to some of you guys, that sounded crazy at the time. Okay, don't have a recency bias. Okay, think about where some of you guys were 3 months ago, and that sounded crazy because the market was irrationally exuberant, right? Everything was up. It's good times. We got a new president, all of this, right? But 3 months later, 3 months into the year, those concerns, those projections so far are looking much more plausible now than they even were 3 months ago. I'm not guaranteeing anything, but it's looking more likely now than it did 3 months ago that, yes, still more violent volatility is ahead of us, and yes, still more substantial recessionary risk is at play in 2025 and maybe bleeding into 2026. So in a minute, I'm going to try to share why I'm very excited about that as it relates to you guys, specifically your portfolios at BR Legacy. But before I do, I want to give a couple general remarks or an announcement and then a little exercise for you guys. So the announcement is maybe overplaying it, but basically I am going to start making investment-related education videos, investment-related commentary videos more frequently than once per quarter. I'm not guaranteeing to a specific frequency right now, but particularly given the amount of volatility we're experiencing, I don't want to be the real-time financial news guy, and I don't think interacting with your portfolios that way is healthy for you, but I don't want to make you wait 3 months for information that, if you had it sooner, would really maybe help put your mind actually at ease and help you experience this year with a lot more grace. And so I want to be more accessible and more intentional to help people through this year, to guide people and to just clue you in on what I'm thinking about and what I'm perceiving. So I'm not going to email you every time I make a video. If you want to, you can just subscribe to my YouTube channel, and that's where those will be posted. Not every video will be investment related. Some of it will just be general personal finance. But if you want to be in the loop with what's Jeremy seeing on the market, I'm going to make an intentional effort to skew more and more of my videos towards investment related content. Mainly thinking about you guys. It's not to build my YouTube channel. I just don't want to spam you with emails every time I make a video, because it might be as frequently as once a week. It might not be quite that frequently, but if you want to be in the loop on those, feel free to subscribe. If there are any in particular that I want you all to see with particular strength, I might include them in links in my quarterly email updates. Okay, so that is that announcement. The second, this general exercise. Okay, this might feel like an offensive exercise because, again, it might seem out of touch to you, but I want you to try to imagine right now this hypothetical scenario, which is 18 months from now, or let's just say at any point in time from now, okay? Let's say that the total stock market is down 50%. It's worth half as much as it is today. And let's also say in this hypothetical that your BR Legacy portfolios are worth 5 times as much as they are today. I'm not predicting this, okay, specifically, but I want you to try to imagine that scenario for a minute for the sake of this exercise, because in this hypothetical scenario, there are a couple points that I want to speak to, a couple recommendations that I want to make, because I do consider this greater than zero chance that something like that could play out, where most people most of the money out there is down 50%. Your BR Legacy money is up 400%. Plausible, possible, greater than zero chance. A couple tips in that scenario. One, financially, I would strongly recommend, if your portfolio substantially appreciates in a relatively short amount of time, I would strongly recommend that you wait at least 1 year before making any major decision. I wouldn't buy anything. I wouldn't change your lifestyle. I wouldn't change the rate that you give. I would, for a year, just try to digest what just happened and begin to plan. I would love to have several one-on-ones with each of you if this hypothetical played out, so that we can begin scheming together what you want to do. And for some of you guys, that won't, even if your portfolio is worth 5 times as much, it wouldn't necessarily dramatically change your life. But for some of you, that would dramatically change your life. And I don't want you to end up like the vast majority of athletes and entertainers and lottery winners if you happen to have a very quick spike in your wealth. So financially, this is also what Larry Chang recommends, who's a VC guy. Anyways, wait 1 year before making any big decisions. Emotionally, I want you to be so joyful, so celebratory. I want, if your portfolio grows by 5 times in a short amount of time, I want you to be so happy about it. I also want you to be mindful of what others may be going through. I don't want you gloating or being too public about your glee, because it may rub some people the wrong way, right? I don't want you to be secretive by any means. I would love if you told people privately about it so that they might consider becoming clients one day, okay? But I'm just saying, In your celebration, be mindful that others might not be in a celebratory state. Morally, in this hypothetical, I want you to know that you may feel some type of like successor's guilt or winner's guilt. But I want you to know that you would have absolutely nothing to be ashamed of. And in fact, you should be rewarded for your valor. Bravely, in this hypothetical, bravely, together with BR Legacy, you were able to identify and partner with businesses that are changing the world, that businesses that are mutually benefiting owners, employees, vendors, customers, and society at large. Those are the types of companies that I'm looking for and that we are wanting to invest in and be a part of. And for you to identify those, to partner with them, and even to overcome extreme volatility, extreme uncertainty, extreme gaslighting, and more in order to help create a world and a future that your great grandkids would be proud of, that is super valiant. And it's not luck, and it's certainly not nefarious. Your profit in this hypothetical would not be at other people's expense by any means. Very different than The Big Short, for example, the 2008 crisis. The people that profited are the people that bet against the market, that were shorting other companies. That would not be the case in our hypothetical. I do not profit at other people's expense. I do not short companies, etc. Relationally, I'm almost done with this hypothetical, guys. Relationally, I want you to be aware that this hypothetical would be incredibly difficult for you. And in all likelihood, Tesla investors, quite possibly, but especially GameStop investors, would be publicly wrongfully vilified by sources who are privately on the wrong side of history and culpable, really, for the market crash. And publicly, there would be a misinformation campaign, probably, to shift blame towards somehow everything that's wrong with the total market is related to people who invested in some specific companies that happen to be doing well in spite of the general market not doing well. You'll probably be blamed for robbing teachers of their pensions and for bankrupting other companies and accused of all sorts of horrible, completely unbased things. And the solution following these accusations would be for you to sell your stocks right now. And if you don't, then you're just forever deemed an evil person who did all these horrible things to people. Simultaneously, the common American, including some of your loved ones, will take the bait and join the chorus from a place of anger and fear with their own finances and just a lack of information. It's quite possible that they feel in some way that you are somehow a villain because you are doing well when other people are doing poorly. So mentally, last note is I would just recommend, this might sound kind of funny, but I would recommend in this hypothetical that you take a break from financial news. And I would also like a 6-month break. And I would also recommend that you start or increase the frequency of some counseling. I don't say that as a joke at all. This would be a pretty intense experience if you are up substantially, simultaneously as most people in the world being down substantially. So, sound good? All right, you're tracking with me on this hypothetical. So again, I'm not saying these things will happen. Don't write me off as a crazy person. But again, I feel some responsibility as your financial advisor to prepare you just in case. And I feel a lot better now that I was able to get that off of my chest. Hopefully you're feeling a little bit more prepared. If you forget everything I just said, and 6 months from now we're in a scenario like that, please come back to this video. Okay, so let's talk about Q1. In the macro, tariffs taking the headlines throughout Q1. And even today, I'm recording this on, what's today, April 3rd? So, huge in the spotlight today in particular. And tariffs do add a lot of uncertainty to the overall market. Mainly, they limit the prospects of globalization. So companies with global sourcing, global operations, global sales are adversely affected. The total upside of their addressable market is significantly affected. So it's not nothing, okay? But I would propose that the tariffs are not the primary reason for the market sell-offs that we're seeing. The far more interesting macro dynamic is related to what we've been communicating about for months and months, which is inflation, debt, and interest. And I want to go into a specific subset under this category that has not received a lot of coverage, probably intentionally, and that is the Japanese yen carry trade, which in some ways is a microcosm picture of this narrative I've been talking about, which is that debt levels are at all-time highs, the cost of that debt is increasing, and simultaneously the inflation that we're seeing in our world is higher than it's been in a long time, and in many countries increasing still as well. Well, it is increasing really everywhere. It's just how fast is it increasing? And those things, those dynamics were set in motion years ago, but they are coming to a head. So if you're unfamiliar with the carry trade, basically during COVID, hedge funds, financial institutions, they were able to borrow money from the Japanese sovereign bank at negative interest rates, meaning they were getting paid every month to borrow this money. It's unknown how much money was borrowed during this time, but Deutsche Bank estimates $20 trillion borrowed at negative interest rates or at flat interest rates from Japan. That, just that alone, is already a huge inflationary pressure on top of the trillions of dollars of global money printing that took place during this time. So what did they do with this money they borrowed? Well, they put it into their trading strategies. They invested it. They're trying to make money with that money and then go pay back the money, right? It's free money. And we've talked already about the inflationary pressures, how that is affecting the possibility of a recession. But in this past year, in really 2 years, but at an increasing rate, Japan's government bonds, if you were to look up like their 10-year yield, they are becoming more and more expensive. The interest rates on those, they used to be negative. Now they're up to almost 1.5%, which sounds like, 1.5% interest. That's still really cheap, right? Well, that swing goes from a monthly income being generated to now $24 billion of monthly interest expense based on a $20 trillion cumulative borrowing. So $24 billion a month in interest expense is a huge pressure, and it makes the loans unsustainable, right? You need to pay the loans back, which means the institutions that borrowed need to divest in order to pay the loans back. But if you're going to divest from the investments that you initially made with those carry trade funds, basically you're going to create a downhill spiral potentially. Because what were those funds used for? What were people investing in? How are they allocating investment decisions during COVID? One, they were going long on tech, and two, they were going short on retail, on physical retail. If you divest from longs, right, let's sell the longs on tech, which really everything, it's longs on everything in many ways, but you sell off the highest value companies, the highest multiple companies, you sell off the tech names that you were putting bets on during COVID, you put downside pressure on those asset prices. So if you're selling a bunch of tech, then the tech stock's valuation is going to go down if you're adding a bunch of liquidity to that market. But if their assets going down, then you need to sell off even more, because the asset valuation, the performance of the investment, is how you are funding the debt. It's how you're paying for the interest expense, is the performance on your managed accounts. And so the more that you unwind, the more that you then have to unwind. And with potentially $20 trillion owed, that could absolutely become a recursive cycle that destabilizes US markets. On the other hand, if you were to divest by closing your shorts, right, and saving on interest expense that way, because you're paying interest every month for companies that you've shorted, sold, but not yet purchased. Well, to close a short, it's even worse. It's even worse than divesting from longs, because to close a short requires capital, right? You have to buy the stock back, which means you necessarily have to divest from longs if you're going to close a short. And so you still create that first recursive cycle, that first downhill spiral that we just talked about. But then not only do you have a downward pressure on your longs in that case, but you also simultaneously are creating an upward pressure on your shorts. You're buying up companies that you are short on. And as those buying pressures come in, well, that's going to increase the valuation of those assets, which again is going to increase the interest expense that you owe on however many shorts are remaining on those assets. Are you tracking with me? Is this getting too technical? So basically, that also could become a even worse recursive cycle that destabilizes US markets. Right now, US banks alone, according to their balance sheets, so that's assuming their reporting is 100% authentic and nothing's being hidden, and which is unlikely. But according to US bank self-reporting, there's already almost $500 billion in unrealized losses. Unrealized losses, some of that's bonds, but some of that is sold but not yet purchased, aka short sales that are underwater. So not only, if you close those shorts, okay, not only do you create a destabilizing downward pressure on your longs that you needed to sell to get the money to close the shorts, and not only do you create a potentially destabilizing upward pressure on your shorts, because there is a legal obligation, right, to purchase these shares, and the higher the stock price goes, the sooner the bank wants the money back because they want out of the other side of this trade. But also, you're significantly hurting earnings because you are realizing losses. Every time you close one of these short sales that's underwater, you're realizing those losses. So that goes from a balance sheet item to an income statement item. And if you hurt earnings enough, well, guess what? That's absolutely going to depress the economy. If earnings are going down, right? A contraction. So it's no wonder that this isn't getting more coverage, right? It's also no coincidence that just since the Japanese yield has increased, right, in the past less than 2 years, we've already had a lot of physical retailers file bankruptcy. Joann, Big Lots, Forever 21, Party City, Billabong, Bed Bath & Beyond, even when some of those companies were still operationally profitable. The narrative you're wanting to be told, or that you are told, and that they're wanting you to believe is, oh, well, just no one goes to stores. Of course. But some of these companies were still literally making money. And when a company goes bankrupt, the short sellers are relieved from their legal obligation to buy back those shares. So the more of their shorted companies that they can get all the way to bankruptcy, the more of a slight hope that they have to correct the current state of their balance sheets, right? So to be clear, these institutional players, as it relates to this carry trade, they would much rather divest from longs than close shorts, which is why stocks can go down, even shorted companies can go down. Like everything could be down simultaneously without shorted companies and negative beta companies simultaneously in the same moment going up, which is like we saw in quarter one. It's not one for one. Anytime the stock market goes down, these negative beta companies go up. But often it's more of a domino where, okay, total assets might come down, and in some subsequent amount of time, these negative beta companies appreciate substantially. But of course, shorts would rather avoid that, but they might not have a choice for long, okay? Because the Japanese carry trade is putting an increasingly downward pressure on an economy that is already facing increasingly downward pressures from inflation, debt, and interest rates. And simultaneously, you then have the most shorted company of all time, GameStop, succeeding in dramatic fashion on a fundamental level, which is putting short sellers at an increasing risk of forced repurchases, which again creates a forced upward momentum, which makes the shorts even that much more expensive, makes the realized losses that much greater. There are several simultaneous death spirals happening to the overall stock market. Now, politically, just think with me for a second, going back to tariffs, okay? What is to your advantage if you are in office right now, if you are in charge politically? Option one, you get an imminent recession over with in the first half of your presidency. So the back half of your presidency is associated with a great recovery, or you delay a potential recession as long as possible, and then you risk it occurring during the back half of your presidency. The first one is obviously more preferable. People remember you not for how you finish, but how you start. If you had to pick and you were the president, you would much rather say, let's do the recession now, not in my third and fourth year. Again, if you were president, which is to your advantage? Option A is you paint the recession as an intentional choice that you made through you being a tough negotiator and working to save our country. Or option two, you inform people that, hey, there's a potentially cataclysmic black swan event, and I just want you to realize that, because then you have you have panic rising up in people, and you add culpability to your presidency because these carry trades and money printing happened during your first term. So again, politically, what's to your advantage? Of course, option A, say, no, we're going in a recession because I wanted to, because I felt like it, because I'm a hero. Of course, that would be to your advantage. So I say all this not to sound like a conspirator, but simply to add more context to my conviction that violent volatility in a 2025-26 recession is absolutely possible. And if this is the case, your portfolio will be it is in such an incredible position to capitalize on the domino effect of that volatility. And so I don't want you to be afraid. I want you to be so pumped. Okay, this is like, it's so great to be invested with BR Legacy right now, and I'm so excited for you guys. Volatility, it makes all of us sick. It's hard. It's not easy to get through what you're going through, but for all of you that make it through, I'm just so proud of you. So let's talk about your portfolios. So obviously in quarter one, client accounts underperformed the SPY, largely due to Tesla being down and GameStop being down 33% and 30% respectively. But don't lose sleep, guys. Okay, if you zoom out on a 1 year return, okay, April 1st to April 1st, the average client account is up 51% compared to the SPY up 8.6%. And that's net of my management fee. So don't get it twisted, okay? Volatility is, it's not fun, but it's not the same thing as underperforming. Okay, you are performing a cool 6 times better than the market. Okay, every client account's different. The timing of when you put in money and take out money, etc., is different. Your investor profiles are different, your risk tolerances, but that's just based on the weighted average of all my client accounts put together. As for how I manage your account this quarter, well, going back to last year, you might remember we had some spikes and pullbacks at different times in GameStop and Tesla in particular. We were able to sell those spikes to trim into those upswings, and then to really expand your core portfolio substantially. I mean, we probably doubled the size of your core portfolio in Q2, Q3, Q4. Well, in Q1, we were able to de-risk your portfolio, take gains on a lot of those expansion plays, and buy into some of the big dips that we saw in Tesla, GameStop, and in Mara. And so concentrating your portfolio into names that I understand the best, into names that I feel are best positioned to go into the coming 18, 24 months that we're stepping into. We were also, this quarter, Q1, able to play some of the GameStop volatility. So we were able to buy in the low 20s before their earnings report, trim a chunk at 29 following their earnings report, and then the next day buy back in the low 20s, which is just epic. And I know it doesn't feel epic yet based solely on year-to-date numbers, but just rest assured, I am not optimizing for a specific 3-month window of time. I'm looking to set up your portfolios for long-term outperformance. And the way your portfolios are set up right now, the cost basis that you have in your highest conviction names, I am super proud of where it is and really excited to see it play out. And you're probably thinking, but why did GameStop and Tesla do so bad? Well, again, zoom out, okay, because on a 12-month basis, GameStop is up 90%. By the end of Q1, Tesla up 72%. So again, the market up 8.6%. So they're not doing so bad. Okay, let's just make that very clear. But in Q1, they did underperform. And I want to speak to that for a minute, and then I will get through this last part of this video. So the one thing I want to reemphasize is that I'm focused on the performance of the companies themselves. So even though, their stock prices are actually outperforming on a 12-month basis, and even though their stock prices underperformed on a 3-month basis, it is not performance of stocks, but it's performance of companies that I'm focused on. I am confident that over time, a company's valuation will be reflected, like their fundamental outperformance will reflect in the company's valuation over time. But conversely, the move of a stock price's valuation, the move of a company's valuation, it may or may not be correlated in any way to the fundamental value of the company. So the super encouraging part for Q1 is that the volatility that these two names experienced was not company-specific news, but more macroeconomic and political dynamics, not fundamental company changes. That's huge. Anytime that a specific company's valuation is dramatically impacted by things that have nothing to do with the company specifically, that's generally a great signal, a great opportunity. So for GameStop, I'm going to make a separate video soon breaking down their 10K, their recent SEC filings. I'm super just way too excited about where they are. But all of their company news in Q1 were super bullish, really exciting news, really great direction, really awesome achievements. And yet the company was down substantially. So likely that's related to short sellers rolling their swaps. It's related to the implications of kind of the macro financial situation that I just described, where short sellers need to keep the stock price down to be able to afford to maintain their shorts for a little bit longer, but they're really just digging their own grave. And again, I'm going to make a separate video soon, but just to give you a little bit to whet your appetite at a super high level, with GameStop, you are talking about a company that in 2024 increased their profitability by 1,800%. They saw net growth in institutional ownership of their stock. They became operationally profitable in their U.S. division, which is by far their largest division, and in a couple years will be their only division. So they are already operationally profitable. And then they also saw revenue growth in their collectibles division. And right now they are valued at just 1.5x their cash value. They are so amazingly priced right now. It's crazy. In 2025, you'll see it become profitable in every quarter consecutively. So not just a total year profitability, but profitable every quarter, including quarter one. You'll see revenue per store increase in 2025. You'll see it become operationally profitable company-wide, not just in the US. And when you factor in interest income, they will be increasingly net profitable on a full year basis as well. And then in 2026, you're talking about S&P 500 inclusion. You're talking about total company revenue increasing. So not just revenue per store increasing, but total revenue increasing. And then you're talking multiple expansion as GME's valuation has to start accounting for its growth in top and bottom line. And at some point in there, you're going to see GameStop deploy a portion of their huge liquidity pile into expansive M&A opportunities. Most likely, in my opinion, they're going to start with DK Butterfly in order to capture their NOLs and scale the same way that Berkshire Hathaway scaled when they transformed from a small textile business to the behemoth holding company that it is today. I think GameStop's going to follow a similar path. And they have been waiting. They have been waiting for extreme turbulence. They've been waiting for a market sell-off before deploying that capital. And so they are being rewarded for their patience. Every day the market goes down, in essence, the value of GameStop goes up, but I'll save more of that for another video. But it's game over. I mean, for the bear case, it is like, it's so over and it's not even close. And an upside repricing of GameStop shares is imminent. It will not wait until S&P 500 inclusion. It will not. That will just that will keep the run going, but the run will start before then, no doubt. So let's talk about Tesla. So decline in Q1, partially due to tariffs. Okay, the implications of their global sourcing and selling is hindered based on the tariff situation. But I will say, just relative strength-wise, they are probably less hurt by the tariffs than other automakers because, one, they manufacture a lot in the U.S., so they can sell U.S. cars in the U.S. without any tariffs. But also, they fully own their international locations, their international manufacturing plants, whereas other automakers, it's joint ventures. And so that gives Tesla some opportunity there. And they just have a lot of favor with the Chinese government. Elon's kind of like almost like a hero figure there. So I don't know, you could see that shift. But overall, in terms of relative positioning within the auto industry, I feel great about where they're at as it relates to tariffs. But no doubt tariffs are going to hurt them in the short run. The question for me as an investment manager is, hey, do these tariffs affect Tesla in the long run? And then also you have the political backlash against Elon Musk, which I want to speak to as well. And hey, does Elon's role in the government, does the social unrest related to Elon Musk, does that affect Tesla in the long run? Does that fundamentally affect my view of the company? So with the tariff thing, again, relatively, I feel good about their positioning. But even if tariffs got super extreme, let's say they keep escalating, and let's say the whole world permanently shifts away from globalization, just, the most extreme scenario you can imagine, I still do not see that as a fundamental threat to the long-term value of Tesla. And the reason is the long-term value of Tesla has less to do with their vehicle sales and has much more to do with their technology sales. In the short run, it would be so painful for Tesla, no doubt about it. but I would be buying that dip hand over fist. But long term, you are talking robotaxi licensing and operating. You're talking AI compute, energy charging and storing, humanoid robot. Those are all larger opportunities than the sum of their entire vehicle sales opportunity. And there is no company on earth seeking to compete in as large of a total addressable market as Tesla is. And that would remain true even in a tariff war scenario. But it would make 2025 ugly. Which brings me to the social unrest. So, long term, the fact that people are not liking Elon Musk, not liking Tesla, okay, that's that's not something that I feel threatens the company long term. I mentioned in my Q4 video that this 4-year window of government administration siding with and giving favor to Tesla is hugely important because they are looking to start new products that have never existed before, especially their robotaxi and their Optimus robot. They are set to launch in this 4-year window. And so the fact that people have socially have some unrest or have rallied against Tesla, that only magnifies the governmental favor that the company already had. I mean, they went from 3 months ago, I was saying, guys, this is great because the government's going to let Tesla do whatever they want to do, to now 3 months later, literally the president is advertising their cars and the FBI is seeking anyone that is trying to vandalize their cars. Like, it's going from we'll let you do whatever you want to like we will help you do whatever you need. And that is so bullish. I mean, it is regulatory risk, not brand damage, that is the biggest long-term threat to Tesla's valuation. And the regulatory runway, in light of the social unrest that's happened, has never been more secured for Tesla. And that's really exciting. As for brand impact, do I think long-term the brand of Tesla will be damaged by Elon Musk's role with this current government administration? I don't. Short-term, sure. But 5 years from now, 10 years from now, do I think people will refuse to own a Tesla because Elon Musk, because Donald Trump? I don't. But even if they did, we're still fine. Because more importantly, I don't think that Ford and GM will refuse to license Tesla's FSD software because Elon Musk, because Donald Trump. I don't think citizens will pay 3 times as much for an Uber with a sketchy driver as they would for a robotaxi because Elon Musk, because Donald Trump. I don't think people that drive other electric vehicles, I don't think that they will just stop going on road trips under any circumstances from here on out just to avoid having to use a supercharger because Elon Musk, because Donald Trump. But you know what I do think? I think 5 years from now, 10 years from now, there will be a substantially larger percentage of Republicans who drive a Tesla. Why? Because Elon Musk, because Donald Trump. In 2023, just 2% of Republicans either owned or would seriously consider owning an EV, compared to 28% of Democrats. In 2024, in March, that was 8% of Republicans and still 27% of Democrats. Now go into election season, November of 2024, that became 15% of Republicans and still 27% of Democrats. Now, in March of 2025, a Morning Consult survey, 27% of Republicans said not just they would consider buying an EV, said they would consider buying a Tesla. From 2% to 27%, almost all tied to because Elon Musk, because Donald Trump. Republicans are not suddenly incredibly interested in sustainable energy or in saving the environment or in eliminating the use of fossil fuels. And simultaneously, Democrats are still just as committed to environmental causes as they were before. Also, in March 2025, Google Trends for the search term "buy Tesla" skyrocketed by 6x their recent averages to the highest point it's been in over 5 years, twice as high as it was just a couple weeks before when Trump himself bought a Tesla, encouraged people to buy a Tesla. That spiked attention by 3x its previous average, and it's twice as high as it was even then, following the acts of vandalism against Tesla. So you are seeing an exuberant support of Tesla growing amidst a completely new customer base, while simultaneously the left is just as likely to buy an EV as they were before. Maybe they're less likely to buy a Tesla. That's fine. As long as they're not trading in their Tesla for a diesel truck, we're great. EV competition is not bearish. It is bullish. EV adoption is bullish for Tesla. And so, in other words, once again, Elon Musk has successfully accelerated our world's transition to sustainable energy in as controversial of a way as possible, like he does. And that's Tesla's corporate mission, right? Accelerate our world's transition to sustainable energy. And this is the world that Tesla has built the infrastructure for. So again, for someone to switch to a competitive EV, not nearly as threatening as someone to move away from EVs into a diesel or gas car. And that's not what you're seeing. It's kind of like, I was telling my dad this the other day, like, what if Jerry Jones did something and everyone decided to just hate Jerry Jones? All the NFL fans just started hating Jerry Jones, and so they start, hating the Cowboys. Well, guess what? If every news out there is going to talk about how much they hate the Cowboys and how the Cowboys aren't going to be any good, and it's almost like that in and of itself is like, and let's say I'm going to cheer for the Eagles now, or I'm going to cheer for the Rams now, or hey, I'm going to cheer for the Houston Texans now. Go Texans, baby. Like, that doesn't really hurt Jerry Jones because you're still in the NFL ecosystem, first of all. And second of all publicity is good publicity to a certain extent. And for whatever reason, you can't stop talking about how much you hate the Cowboys. And that's actually boosting their infamy. It's boosting their brand. And let's say that you took, for some reason, people's hatred towards Jerry Jones within the NFL fan community somehow incited an intense support from people that previously had no interest in sports whatsoever. You get a bunch of scientists and a bunch of theater actors, and you get a bunch of people that are just so far from the sports world, all of a sudden saying, we're going to become season ticket holders. We're going to fill the stadium. Like, we can't let the Cowboys die. Like, the net addressable market for Jerry Jones and the Cowboys increases in that scenario. Okay, so in Q1, the sales were rough, no doubt, for Tesla. But I just want to reiterate, or I haven't actually said this yet, I just want to highlight that this is largely probably due to their own products than boycotts. And what I mean by that is they are refreshing their Model Y, and that starts in Q2. So there's a lot of people that are waiting until the new Model Y comes out instead of buying one in Q1. Which, speaking of their original Model Y, I just want to say that, hey, it was launched in 2020, and yet in 2023 and in 2024, it was the world's best-selling vehicle. And the Model Y will be in 2025 as well. But beyond that, Tesla also has shared late last year that they will be launching multiple new vehicles in 2025 that will be considerably more affordable than their current offerings. So not only will that increase their customer base dramatically, but it also is probably cannibalizing some of their Q1 numbers. People waiting say, why would I get a Model 3 for a time and a half the price when I could just wait for the vehicle that they're going to announce later this year? So I'm not trying to defend their Q1 numbers. I'm just trying to reiterate the bear case is incredibly temporary in nature as it relates to the downside pressures on Tesla, whereas the bull case is actually clearer than it's ever been and in a better situation than it's ever been. So that's a little bit about Tesla. I will be recording a video soon, probably multiple videos to dive deeper into GameStop and other market dynamics. But that's all I have for you now. Sorry, this was long-winded. Thank you guys, as always, for your trust. I'm super excited about your portfolio. If you want to have a one-on-one or move any money in, or you want to talk any questions, feedback, always feel free to reach out. I will talk to you guys soon. I appreciate y'all. See you in the next one.